I want to bring in Jim Bianco, the president of Bianco Research, who is also sticking with his guns. And he says, he's one of those guys who says, Fed's not going to raise rates this year.
Oh, he agrees. Oh, good.
Go ahead, Jim.
Oh, okay. Yeah, I don't think I think what you talked about with PIMCO is the big issue right now as far as all the Fed watchers and the Fed. The market is priced in something different than what the Fed is saying to us right now. And I think that as long as they...
What is the Fed? Are you saying
they're going to raise rates?
Is saying in September?
No, I think the Fed wants to raise rates maybe 1 or 2 times this year. Maybe, and I think the market is saying, no, you're going to move probably 1 at the most, and maybe not at all this year. So there's where the difference is right now. The market is a lot more dovish than what the Fed is saying. And as long as that divergence continues, I think the Fed ultimately caves to the market and won't move. I think that financial stability is a critical thing for the Fed. They don't want to raise rates when the market's not ready for it and watch something adverse happen in markets. This is not the Volcker Fed right now.
So you don't think that the Fed is really data dependent? It's more market dependent.
Can we be, let's be honest between you and me. Data dependence means whatever you want it to mean. You want to not move, I can give you a set of data. You want to move, I can give you a set of data. It doesn't mean anything. It means whatever they want it to mean right now.
But aren't you using data to make your case, though, that, that the Fed's not going to move?
Yeah, the data that I'm using is that the market is pricing in something a lot less than what the Fed is. Yellen, in her speech in San Francisco a couple of Fridays ago, said it was a sobering fact that the market doesn't agree with the Fed, and they take that very seriously, I think. And that is the biggest stumbling block they have. I think every speech the Fed gives right now is to try and convince the market to price in a hike. If they do, they'll raise rates. But right now, in fact, if anything, the market's going the other way. It continues to fall in yields as the Fed continues to say they'd like to move somewhere in the summer or the fall.
Jim, what's your take on earnings? This is the busiest week of earnings of the whole quarter. Obviously, estimates were revised downwards significantly. So, yes, once again, nearly 80% of companies are beating on the bottom line. What's your take on earnings? Is it strong enough to move the S&P another leg higher?
I don't think so. I think you're right. I think what you said is important to understand. We expect earnings to be negative growth rate on a year-over-year basis. There are no earnings growth. We're just arguing about what negative number, but there'll be a minus sign in front of it. And yes, 80% or 75% of the companies beat. That happens every single quarter and has for almost 20 years. You could just start yelling beat 5 seconds before a company reports, and you're going to be right 80% of the time. And so when you factor out all of that, and I think the Street does, they look at other things. They look at revenues. About 35% of companies have beaten on the revenue line, and that's not very good at all. And they look at guidance, and most of the companies are telling us that it's still going to be a struggle for the rest of the year. And those are the worrisome things. So I don't think the earnings numbers are anything to get excited about. I think, if anything, what the market is hoping for is that the Fed's not going to move, and stimulus works, and you're getting it out of China, and you're getting it out of Europe, and you're getting it from Japan.
So, Jim, if because don't you have you have a 0% return on stocks this year, right? So if the Fed doesn't move, does that change?
No, I think that zero is predicated on the Fed not moving. Bad earnings are going to meet easy Fed policy, cancel each other out. You're going to get kind of a zero-ish return. You're up 1% right now in the Dow for the year anyway. So right about where we are now is where we'll end the year. And so, you know, if the Fed were to move, I would probably turn a little bit more bearish, because I think that the offset I'm looking for in the poor earnings, because the second quarter and the third quarter estimates are also for negative year-over-year growth and earnings. The first time that we've had multiple quarters of negative growth since the Great Recession.
So, Jim, you're saying that if PIMCO is in fact right and the Fed does hike rates this year, we are going to see the S&P fall for 2015.
If you ask any manager in the abstract, what's a good time to sell stocks, they'll probably tell you when there's no earnings growth and the Fed's raising rates. Well, that's what would have then this year.
But actually, I know that if you go back, the data shows that stocks tend to rise into a rate hike cycle.
Well, this is a different type of rate hike cycle now, because we're now at zero and we've got quantitative easing, and this is not the traditional rate hike cycle right now.
Well, you probably don't tend to see rate hikes when earnings are falling year over year, especially if they're down 5 or 10% year over year. Why would the Fed raise rates into that?
Well, that's exactly why I said that if you ask people in the abstract, Negative earnings means the economy's not doing that good. Companies are not doing that good. The Fed is raising rates, and that's more restrictive. That's a double whammy, bad news for stocks. Normally, we raise rates because earnings are booming and the economy is booming.
Yeah.
We don't have that right now.
Can I just ask?
And that's why.
Can I just ask? Look, okay, so earnings may be down year over year. The economy's not booming, but it's still growing. Does this economy look like we should be at zero interest rates? I mean, if you were the Fed, would you say we need to at least get off the zero bound, market be damned?
I think the Fed should raise rates. I mean, I've been talking about what the Fed, I think, will do. If you ask me what they should do, they should raise rates. They should have never done QE3. I think that all of this easy policy actually works backwards to some extent, and that it restricts a lot of people, that makes them unsure about the economy. I know a lot of Fed officials disagree with that.
Right.
But I'm not on the Fed, and they're not thinking in those terms.
But
they're trying to massage this situation right now.
But you know what? Why even bother trading, Matt? Because you think this whole market's rigged anyway. You think there are...
Well...
You think there are...
Do I think
all over the place?
She's asking if I think high-frequency traders are spoofing constantly anyway, and the answer is yes, I do think they are, not just Sarah. I'm sure that most traders, I'm sure you agree with as
Jim,
well.
Betty is pointing out that Matt believes in a lot of conspiracy theories. That's all.
I left my tin hat at home today.
You're right. You're right that a lot of computer algorithms are really dominating the market. Whenever a piece of data comes out and the market moves wildly, that's not human beings making a decision. That's computer algorithms reading the headlines and reacting off of it. So we do have a lot of that in the marketplace that we didn't have just a few years ago.